Nobody enjoys having to repay student loans. It could strain your finances and keep you from making the most of your money. Student loans may significantly reduce your paychecks, making it challenging to achieve your financial objectives. Learning how to repay student loans more quickly will help eliminate this debt. The total interest paid will be lower if you repay your loans sooner. In the end, you might discover that you have extra money to spend on anything you need, such as a house or a new automobile. In this video, we will discuss how to pay off your student loans fast and 5 facts about student loans that will save you money. The video will be amazing, so stick to the end. Before starting the video, smash the like button and subscribe to never miss out on any of our videos. Number 4. Pick the right repayment plan and use a cash windfall. A 10-year standard payback schedule is automatically included with all federal loans. A 10-year plan is usually customary for private loans, while some lenders offer 20 and 25-year programs. The quickest strategy to pay off your student loans is to stick to the usual repayment schedule if you cannot make additional monthly installments. Be aware that the federal government can prolong your payoff date to 20 or 25 years, even if it provides aid to needy individuals, such as income-driven repayment arrangements. Additionally, consolidating your student loans may enable you to extend your plan by 30 years. Nevertheless, it might be worthwhile to change your repayment plan if you need help to make the minimum monthly. A 10-year standard plan is a good option. Nevertheless, if your ultimate objective is to pay off your debt quickly, you can make monthly installments. Any unanticipated or bonus income, such as an inheritance, lottery winnings, a settlement from a lawsuit or insurance claim, employment bonuses, or a sizable tax refund, might qualify as a cash windfall. If you suddenly receive a large sum of money, you might be inclined to treat yourself. Applying part or all of it towards your loan balance will significantly reduce the amount of debt you owe on your student loans. Make a decision in advance regarding how much windfall money will go towards student loans. After you've taken care of the necessities and saved some money for emergencies, you can put the remaining money towards your student loan account. Number 3. Avoid capitalized interest. Your loan, excluding subsidized federal student loans, will accrue interest while you're a student. Interest on subsidized loans also accrues, but is covered by the government while you're in school. All of the interest capitalizes or is added to your student loan balance once you begin repayment. Therefore, you'll be paying interest on top of interest. Making monthly interest-only payments throughout your time in school and the 6-month grace period after graduation will help you avoid paying capitalized interest. Additionally, even if you put off repayment with a deferment or forbearance, you can still choose to pay at least the interest due and stop the balance from rising. Alternatively, you could pay for everything at once as soon as your installments start up again. Number 2. Consolidate and refinance. Consider considering a student loan refinance if you have a reliable source of income, a credit score in the upper 600s, and a debt-to-income ratio below 50%. Your interest rate may drop if you refinance, allowing more of each month's payment to go toward the loan's principal balance. If you choose to prolong the term of your loan, refinancing may also enable you to make a smaller monthly payment in addition to, ideally, lowering your interest rate. If it's more convenient for your position, you can refinance only one student loan at a time or combine all of your loans and their separate monthly payments into one bill. Remember that getting a cheaper interest rate is the main benefit of refinancing. Therefore, it is preferable to stop the process if you need help locating favorable loan conditions or rates. Number 1. Pay more than the minimum each month. Paying more than the minimum each month is the most transparent approach to paying off your student loans faster. To determine the effects of additional payments on your student loans, utilize a student loan calculator. Try experimenting with different numbers to see how quickly you can repay your debt. Unfortunately, making additional payments is more challenging than it seems. Additional fees are handled differently by each loan servicer. Your extra money may be used for interest by particular lenders or for your next month's payment by others. However, applying the additional funds to your loan's principal balance or the loan with the highest interest rate might make more sense. Determine how you want the additional payments to be applied and check to see whether you may do so on your lender's website. If not, get in touch with the lender and determine how to guarantee that any additional payments are correctly applied. Now let's talk about some student loans facts that will save you money. Number 5. Not all student loan services are created equally. Some believe that acquiring a student loan from any organization or bank is equivalent. They all offer the same thing, except for a slight difference in interest rate. Sadly, many millennials have learned that some student loan businesses are less reliable than others. There are many reasons why searching around for the finest service and most excellent options will ultimately save you time and money, whether it's a dearth of payment methods, like to-no deferment, or just plain unpleasant customer service. Number 4. Slight differences in interest rates and origination fees can mean big dollars down the road. The percentage interest rate you pay for borrowing money is based on the principal or the total amount borrowed. Interest rates may be fixed or variable depending on your loan, and understanding the difference will help you save money. For instance, if you decide to take out a loan with variable rate because it is now low, you should be aware of the potential increase since this could influence your choice. Consider the length of the loan and other costs in addition to the interest rate when comparing loans. For instance, specific lenders or products may impose an origination cost. Here is an example to illustrate how some of these factors might work out. An undergraduate borrows $20,000 with a 7% interest rate and no origination fees. This loan has a monthly interest charge of $25,600 when it is paid back in 48 months because of capitalization. A student borrows $20,000 with an interest rate of 8% and an origination discharge of 4%. This loan has a monthly interest charge of $27,456 when it is paid back in 48 months because of capitalization. Even though it seems like a simple adjustment, it makes a big difference. Number 3. Keeping an eye on your principal can help you understand repayment progress. Your loan statements will show your principal and payback balance. You should keep track of those monthly amounts. Of course, you want to see a downward trend, but occasionally keeping track of your monthly principal balance will clarify how much more of an impact you could have on your debts if you raised or rearranged your payments. Number 2. You should pay interest while you're still in school. Compound interest is one factor that justifies making even your interest-only student loan payments while you're still in school. When your interest is compounded, the principal is also increased. When this occurs, you wind yourself paying more interest because your principal is higher. Pay interest to counteract it. If you make these modest payments while still enrolled, you will only graduate from college with more debt than you started with. If you put off paying your debt, it will keep growing until you begin making payments. Some people get in a lot of trouble by doing things like this. Number 1. There are different reasons to consider fixed or variable interest rates. Private loans can have fixed or variable rates, but government loans are always fixed rate. Choosing the right loan can help you save money if you're aware of both options' advantages and potential drawbacks. For the duration of a loan, a fixed rate lets you know what your costs will be. Uncertainty surrounds variable rates. There is a chance that the rate will start out low and increase over time, or the opposite may be accurate, but they also typically start out lower than the fixed rate. Consider the variable rate's setting and decide whether you prefer the fixed amount or are fine with a fluctuating rate. This was all for today. I hope you liked the video. Let us know your opinion in the comments section below. Stay safe, and we will be right back soon with another video. For more information, subscribe and watch other videos from our channel.